If you can see and hear, just wave your hand right here in this screen a little bit so I know this is working. Okay, great. I'll introduce Mike, even though he's not quite here yet. Mike will join us. Mike is the vice president of Surgent. Mike is responsible for all of Surgent's webinars. Mike has experience with, most recently with TM Bixby, a significant local firm up in Connecticut. He had a stint with KPMG and also with Deloitte. Mike is an honored educator. He's received awards from several state societies for being an outstanding CPE presenter. And we're fortunate to have Mike with us. He looks much better. We can't always get Mike to put on a tie, and I'd be willing to bet that he won't be wearing one today either. So this is Tax to the Max, a weekly symposium, and that word contemplates that there will be some participation on developments in U.S. tax law, cases, rulings, IRS pronouncements, your questions in real time, and occasionally, like today, a visiting expert. This is a member benefit as your member benefit from the South Carolina Association of CPAs. You will see me look to my right. That's where all of you are. My slides and I'm looking at are in the middle here, and then all the pictures of you are over here. So if I'm looking this way, it's because I'm looking at Steve or Marcia or Whitney or Catherine or somebody over here. All the comments are obviously informal. We don't have time to stop and do research. So you should consult appropriate authority before you taking a position on any item discussed in the program. And as always, I acknowledge the value of my subscription to Tax Analysts, or Tax Notes today. In my opinion, Tax Analyst is the preeminent source of current information for tax professionals coming out of Washington, D.C. I've relied on them for over 30 years. It's a long-term relationship, and I highly recommend them for a source of good information on tax developments. So what's on the program this week? For sure, 6 items. I have some thoughts on Grantor Trusts that Mike will help us with when he gets here. New development in small captive insurance company fight that some of you may not be interested in the small captive aspect, but I think we're all interested in the way the IRS conducts itself in litigation on important issues. Tax rules for pass-through entities that own an interest in a passive foreign investment company. A little too complex for some, but basic for others. We have more of us are increasingly encountering complex issues, including foreign tax issues, foreign income tax issues, in what used to be a fairly easy to handle tax preparation business for high income individuals, high wealth individuals. Increasingly, we find them making investments overseas, and we have to be proficient in dealing with the results of, for example, an investment in a partnership, which in turn makes an investment in a passive foreign investment company. And then we want to talk about how a non-filer can claim tax credits. There are 3 tax credits that can be claimed. I was addressed to that non-filer got my attention, but it's not necessarily someone who decided not to file. It could be someone who's not required to file, but still gets tax credits. An updated website for child tax credit access, which is one of those tax credits, and the IRS is relying on its website, frequently asked questions, to relieve some of the burden on IRS personnel. And by the way, there's conversation this week about transferring some IRS personnel from other duties to return processing. They are months behind processing returns that were mail-in returns. And then there's a Ninth Circuit opinion on protection for dual purpose communications that contain tax advice. And whether you know it or not, if you send a client an email answering a tax question, and certainly if you write a letter offering a tax opinion, you are entering in an area where we need to have a little bit of knowledge about how the law works, not just for accountants, but for everyone. And there is a special provision Code Section 7525, which offers privileged communications to accountants for the tax advice they give a client and for the information the client gives the accountant to get that tax advice. We just want to make sure that we don't do anything to bust that privilege and leave our client open to discovery when they didn't expect to be. So let's get some thoughts here on Grantor Trusts. I've been at this a long time, as many of you have, and it never occurred to me that I would ever have to worry about a Grantor Trust being anything other than an extension of its owner. But a little research, that wasn't always the case. In Revenue Ruling 85-13, the IRS had to deliver its formal guidance that a grantor trust was treated as owning the assets of the trust for all federal income tax purposes, and the grantor of the trust was treated as the owner of those assets. So the individual and the grantor trust were the same as far as owning the assets. And then 10 years before that, in the Swanson decision, the tax court had said that the receipt of income by a grantor trust was attributable to the grantor. For many of us, our careers in taxation started after 1985 and certainly after 1974. And so it's always been a given that the transactions in a grantor trust were attributed to the grantor. So if it's all that old, why are we talking about grantor trusts in a tax update program in February of 2022? Good question. And our companion over here, you'll see his jaw has dropped. He wondered the same thing. Well, it's because the Build Back Better Act initially proposed a change in the law that would have reversed 37 years of basic rule of trust taxation from that 1985 revenue ruling. If nothing else, it should be a reminder that we all have to be vigilant in the attention we give to proposed legislation. It's not always going to say tax update. It won't always say tax reform. It may say Build Back Better. It may say some other high-minded, legislatively created title to get political support. Now, when I wrote this slide, it was during the week. When I was today checking on current developments, I discovered that this may not be all that dead. So stay tuned, as they say, for the latest information coming later in this program. Micro insurance. Two topics that are blended for federal tax purposes. This is Mike. Hold on a second. Hi, Mike.
Hey, Lynn, how are you?
I'm fine. Are you having trouble getting in?
I am, yes.
Okay. Mike, you should have received an email from Whitney Lewis.
Yes, sir. I sent it over to him.
And I think probably Whitney's on this call.
Yes, I did.
She will see that you get the information to log in right away.
Okay, yes.
Don't worry, we're doing fine.
Okay.
You can catch up. You can catch up when you get here. Okay.
Okay, very good.
See, it's an informal program. We take care of what comes up when it comes up. Okay. Micro captives are a creature of federal tax law. It's a small captive. What does the term captive mean here? It's owned by the same entity, either directly or indirectly, for which it's insuring certain risks. One of the landmark cases is a hospital holding company, hospital corporation holding company that owned an insurance company that insured a lot of risk for the hospitals, and it actually was saving money. It was getting a tax deduction on this side and not paying tax on income on that side. That's very engaging, very, very tempting. So this micro captive is a small captive insurance company. It's taxed under Internal Revenue Code Section 831B, and that provides that it can be this small company can be taxed as a U.S. insurance company and pay tax only on its investment income in any year that its written premium is at or below the threshold for the applicable tax year, which now is $2,450,000 a year. So the owner of a captive company can take a tax deduction in one member of a controlled group, for example, for $2,450,000 and not pay tax on that $2,450,000 anywhere else in the controlled group, because all of it or some significant part of it would be an underwriting profit. So we all understand the idea is to let insurance be written in certain circumstances where insurance is simply not available by a company with lots of risks. Let me explain what that means in terms of Paul Puglisi. As you might guess from the cartoon, Paul Puglisi's business was egg production. They're up in New Jersey, and they employ tens of thousands of revenue producers in the form of hens. Those revenue producers could be completely wiped out by the avian flu, but there's no insurance company that will write insurance insuring against the avian flu in flocks of chickens. So the Puglisi family organized a micro company. They owned the company, paid premiums to the company to insure their chickens against the avian flu. The IRS attacked this entity, as it has attacked hundreds of others, seeking to disallow the deduction and treat the whole transaction as a sham. But this is not exactly like a lot of those others. There are hundreds of micro captives that are under examination because the IRS believes they're not operating as intended, and it's true. There are a lot of micro captives that were sold as tax shelters, that have been operated as tax shelters, that have purportedly insured outrageous risks that could never happen. But wait a second. What risks are outrageous that could never happen? How about an influenza pandemic that has killed almost 1 million people, that has caused businesses to be shuttered? That's a 100-year risk. But actuaries know that there's a risk like that. The IRS has argued that, that could never happen. Really? An automobile dealer's supplier could never go bankrupt. Really? And yet it happened in the 1980s. So these companies are legal. The IRS doesn't like the fact that many of them have been abused. The owners pay the premiums into the insurance company. The money never leaves the house. It gets transferred into operating companies, so they use it to fund other things. They buy stocks and bonds, or they buy stock of another company in the group. You can't do that. You still have to operate that little company as an insurance company. But what we've learned is that hundreds of others will not be examined because they clearly fit within the intended purpose of the statute, allowing businesses to buy. I have a client, 5 automobile dealerships, has a captive company that is administered by Zurich that writes rim and tire insurance. There's no place else that the customer who buys a new car can buy insurance against damage to rims and tires in Pennsylvania, where potholes are the order of the day. So rim and tire insurance is legitimate insurance. This automobile dealer makes money selling it, and they have a captive. They have a micro captive, which is administered in accordance with the intent of the statute, and the IRS has never even thought about touching it. So why did they come after Puglisi's chickens and his eggs? Well, we're learning about supply chain interruption. we're learning about government action or inaction. So what happened with Puglisi? Why are we talking about it? The IRS folded. Puglisi's under examination, and the IRS realized that they've got a captive insurance company here, which is insuring a risk that no insurance company will insure against. They realized that the Puglisis were administering this captive in accordance with any reasonable interpretation of the statute. They weren't taking advantage of it. They were investing the premium dollars in case they had to pay. Benefits. So the speculation, and this is a fairly close community, by the way, of those of us that are trying to keep track of what's going on with micro captives. I have a friend out in Phoenix, a lawyer that has over 100 of these cases, actually almost 200 in his portfolio that he's defending, and he's helped me keep up with this. The IRS has too much invested in a total disallowance to risk a defeat of any kind, so they just stopped. And Puglisi doesn't get an opinion. The IRS was not willing to take the risk of litigation in the event that they lose, and that gives encouragement to other micro captives who are being forced to incur significant expenses in litigation when in fact they are not breaking or even stretching any law. It's something to think about. As we are, many of you who join in this weekly program are in the tax advice business. You're the senior tax person in your firm, or you're maybe the only tax person in your firm. And it's important for you to know how the IRS operates and what happens when they lose or they're afraid they might lose. And a precedent gets set that's taxpayer favorable. They simply fold, and you don't, not only do you not get an opinion, you don't get your expenses reimbursed because they didn't lose. They settled.
Hey, Lynn, I think that Mike is on with us now. So just wanted to let you know.
On the treatment of domestic partnerships to determine the gross income of their partners with respect to their investment in foreign corporations through a partnership. So this is the proposed regulation. You got final regulations and proposed regulations at the same time. 92 pages of proposed regulations. It's fairly detailed, fairly topic. But the bottom line here is the IRS has said that a partnership which invests in a passive foreign investment company will receive that income. They'll receive the report of income on an aggregate basis, and each partner will then pick up their proportionate share of passive foreign investment company income, which is taxable in the year it is reported to the partner without regard to whether or not it is received. To that extent, it's not totally unlike the issues that we have with a U.S. shareholder in a controlled foreign corporation. So this, for those of you that have a high level tax practice with high income, high wealth individuals who are partners in some of the more sophisticated investment partnerships that are run by the investment banks out of New York, where they're investing in passive foreign investment companies, that income is going to flow through and be taxable even when it's not received. And sometimes you don't get the information until the day before or the day of the deadline. And that information may be, oh, by the way, we should get an extension because we're not going to be done. Or they send you something that's half done and a little note that there will be changes. And so you know that you need to go ahead and file, and yet you're going to have changes. You're going to have to file an amended return. How long do you wait? It complicates your tax practice, and you need to figure out a way to make sure you get paid for it. That's an issue that we all deal with on a regular basis. So it's good to know before proceeding, I suppose, to talk about that, what the code sections are that are referred to here. 956A amount, that's the determination of controlled foreign corporation income. 951A, that's controlled foreign corporation income required to be included in the shareholder's gross income, whether they get it or not. And both of those rules relate to income required to be included in the taxable income of the United States shareholder in a controlled foreign corporation. A United States shareholder is any U.S. person, individual, or entity that owns at least 10% of the voting power of a foreign corporation. So now we're ready to look at the next item. Pass-through income from a passive foreign investment company. Final regs clarify the aggregate treatment of domestic partnerships, ensuring that a U.S. shareholder determines their Section 956 amount regarding controlled foreign corporations, and we know what that is, as part of the U.S. shareholders Section 951A inclusion. That's a long technical walk around the barn to say if you've got an investment through a partnership even in one of these passive foreign investment companies, you're going to report the income in the year it is calculated and reported to the partnership in which you're a partner, and you're probably not going to have that information to file on time. So don't plan on it. This next headline might be misleading. I thought it was misleading. It caught my attention. If you're a non-filer, so what do you mean non-filer? I didn't know that the IRS, I can make that decision. Revenue Procedure 2022-12 provides guidance for individuals not otherwise required to file. Oh, that's it. So if you're not otherwise required to file, how do you get the child tax credit? How do you get the recovery rebate credit? How do you get the earned income credits? Those are all refundable credits. I don't have to file a return, but I can get money if I do. Eligible individuals with an adjusted gross income of 0 can file electronically, but must enter $1 for their total income. I didn't know that. I didn't know I could do that until I read this. Now, there at the bottom of this slide, and you can download these, by the way, Fact Sheet 2022-03 lists 14 categories of information for non-filers, but at the top of the list are these words: do not call the IRS. We're giving you all the information you need. If you don't understand it, it's because you're a dummish. Don't call us. We're busy doing other things. Fascinating. I think Mike might have just got here. We went up with by one participant, but he'll figure it out or not.
Hey, Lynn, Stephen has a question. He's got his hand raised, so I don't know if you
outlines
want
a simplified procedure for paper and electronic filing. You're claiming multiple credits. The IRS will process both categories of eligible individuals Form 1040, 1040-SR, 1040-NR if, in addition to providing the general required information listed in the RevProc, you indicate RevProc 2022-12 on the filing form. You got to, if you're filing paper, write it in bold letters across the top of the form, filed under Revenue Procedure 2022-12. January 24th, the IRS updated its guidance on the child tax credit. I have a lot of fun finding these cartoons in clip art. Sometimes, well, you got to research the tax law. Then you got to find the cartoon so we can have a chuckle along the way. Oh, we're picking up audience. This is terrific. So the IRS directs taxpayers to free filing options in order to file your returns, allows you to access the remainder of the child tax credit or the full amount of the credit. Based on the answers to questions about gross income, the website will refer you to the appropriate software. And I checked this out. The website refers you to the free file software, which is available to your income level. Eligible families get the full credit if they made up to $150,000 for a married couple or $112,500 for a family with a single parent in 2021. And they get a phased out credit if their income is above that. But you can get directed to the right free file software by following the IRS's instructions. Now to protecting tax advice. And I'm really hoping that Mike has joined us. Oh, hi, Stephen. I see Stephen has his hand up. Stephen, unmute yourself.
Lynn, I had, when you're on slide 16, I had a quick question. You mentioned we could download something. Is that these slides? Can we download these slides?
Wait a minute. What's going on here? Maybe it's me.
Can you hear me, Lynn? Can you hear me, Lynn? Lynn, can you hear
It's
me?
me. All right. It was me, Stephen.
Can you hear me now?
I can. Yes, sir.
Yeah, when we were on slide 16, you had mentioned we could download something. Was that these slides that we could download? And if so, where can we download?
Whitney has them.
Yeah, you can't download them. That's how we have them set up for CPE, is for downloads. But if you send the request to membership at scapa.org, we can send them to you.
Okay, that's Catherine. Stephen, thank you.
Excellent.
Catherine.
Thank you. So membership at scapa.org, and you'll send them.
Yeah, that's correct.
Thank you. I'm glad to know that they're going to be helpful. All right. Whatever is, I presume, well, give me just a minute here to take care of how this thing works. Okay. That should do it. There we go. Thank you all for your patience today, by the way. I'm not the world's slickest with the Zoom technology, and Whitney and Catherine are being very patient with me while I learn. Or maybe they're not, they're just not scolding me, and I appreciate that. Okay, let's talk about tax advice. This is here because I think I see a lot of situations where I don't think we're taking this seriously. We have a legally protected, our communications with our clients, if we're giving tax advice, and their communications with us, if they're asking for tax advice and giving us information to get tax advice, are protected from discovery by the Internal Revenue Service. Now, they're not protected from discovery in a state lawsuit of some kind, but the IRS cannot have access to the tax advice you gave a client if you were careful about how you write it and how you protect it. Code section 7525 very clearly says that the advice a CPA gives a client, a federally authorized tax practitioner gives a client giving tax advice, and the information given to the CPA or the practitioner by the client is protected from discovery, like legal advice. And we all have some concept of legal advice being privileged. There's that, the prosecutor cannot force you to testify against yourself, and cannot force information that if your lawyer wrote you a letter or you talked to your lawyer, that's privilege. That's why you asked for a lawyer in the first place. So our advice to the client is protected from disclosure to anyone who's not our client. If we're careful, if we give that information to the client with the expectation of privacy, it is protected by this doctrine of privilege. But there's no grant of privilege to business advice. Well, wait a minute, Lynn, what are we talking about? Tax advice, business advice? My client asked me for advice and they want a letter. That's what I'll do. Well, if you do that, if you don't separate the tax advice from the business advice, then the whole document is subject to disclosure. It's subject to subpoena by the IRS. Now, if you want to, now, if the client expects you to protect it and you don't,
Got it.
hi, Mike.
Hey, Lynn, how are you today?
You are just in time, Mike. We're talking
Okay.
about, Mike is a lawyer. I'm not. Mike, we're talking about Code Section 7525 and privileged tax advice. You may have heard I was just doing the setup and about to change the slide to talk about this ruling, not even a decision, it's a ruling out in the Ninth Circuit on the protection afforded or not afforded to dual purpose communication.
Yeah, I mean, I think, Lynn, what we're talking about here is privilege is extended if you are giving legal advice or receiving legal advice as opposed to anything else. And it could be anything, you know, you're talking about preparing a document for release, including a tax return. So yes, this went to the Ninth Circuit. The Ninth Circuit is traditionally a liberal court of appeals in the US system. And what they're saying here is that these particular points of information were not privileged and not protected. Where we see this quite often is situations where a client will be audited by the IRS. And there are documents that we have prepared or will prepare, and we want to make sure that the privilege maintains itself. There is a statutory privilege for tax return preparers. It's a relatively new provision. It's not something that has been widely explored, and certainly there isn't much case law on it. So when we want privilege, we immediately shut down whatever we're doing with that client, and we go to the attorney that is working with us, and we enter into an agreement with that attorney so that basically we work for that attorney, and the client is the client of the accounting of the law firm, and we're just helping the attorney get along.
Let me interrupt you for just a second. You're obviously doing good here, but I want to make sure that we separate this a little bit from where we give tax advice. You're absolutely right. Really, the advice should be anytime even though I'm just giving tax advice, if I want communication to be privileged, I think you're absolutely right, Mike. I'm an accountant. I shouldn't try to do the triage here. I should just go to the lawyer, work for the lawyer giving the advice, and then we don't have to worry about any of the fine points of is it protected by the accountant's privilege or not.
Right. Where I see it a lot, Lynn, is in FBAR situations where somebody comes in and they start talking about residence in a foreign country, assets held in a foreign country, bank account, signature authority of a bank account held in a particular account in a foreign country. Those are the situations where I don't want to be the chief engineer of that train. I want somebody else to tell me what to do and not do. And basically the legal issues are issues for lawyers. And, we'll do the tax returns as required. We'll do the data accumulation and to some extent analysis, but we don't need to practice law as well.
I wanted you to practice law just a little bit here because I couldn't resist the privilege. I couldn't resist the temptation to get a short discussion about the difference between the primary purpose test and the because of test. I really haven't, I don't recall addressing this anywhere in my college education, which mostly involved business law. But here, the court here applied the primary purpose test. Was the primary purpose of the document to give or receive legal advice, or was the primary purpose to give or receive business advice? As to the CPA, if we commingle tax advice and business advice, I believe we have no expectation of privilege. Would that be correct?
Yeah, I think that would be correct, Lynn, based on the fact that because we don't know about the preparer privilege, it's hardly ever been exercised. There is no reason to exercise that privilege. And I would think that the common law exception we're talking about here, the common law privilege, is the much stronger position that you would adopt, both as a law firm and as an accounting firm.
Let's move over to get to a different test, the because of test. This is where we work. A lawyer hires me to prepare an analysis, or maybe a without some sort of a tax affected projection that is prepared because of the litigation, and it's going to be presented in court. They wouldn't prepare this but for the anticipated litigation. So there are really two classifications of tests. Does it really make any difference to me as a CPA if I'm working for the lawyer?
Sure, it makes a lot of difference. I mean, it's really, who's the captain of the ship here, and you're going to have to make a determination as to what your role is going to be and the strategy associated with dealing with the IRS, whether it's an interaction with an agent, potential litigation. If I'm acting as a lawyer, I welcome your participation. But at the end of the day, it's my legal responsibility. And I think you should note here, Lynn, that the privilege is abrogated when there is a loss of confidentiality. If you turn these documents over to third parties, you have no privilege anymore. And so if you are emailing and sending copies to third parties, don't do that, because that will waive your confidentiality.
Absolutely.
It used to be in the accounting arena that the accounting firm would actually submit their bills, their invoices, to the law firm. And some may still do that. I don't think that's really called for. You can go ahead and bill the client, even though your engagement letter is with the law firm and not with the client. But the fact of the matter is,
come on, Mike, be careful the level of detail that you put in the bill.
yes, yeah. But be sure that you've got a good letter of engagement and you follow it, and you're not dealing with third parties and disclosing that information, or you have no confidentiality.
Absolutely. Stephen, your hand is still up. Does that mean that you have another question, or that there? Thanks. Okay.
Yeah, it means I don't know how to work Zoom either, Lance.
That's okay. Listen, you're in the right place. This is different. Okay. We don't have a script. We're lucky to have Mike with us today. I really appreciate that.
I'm lucky to be here today, Lynn.
That's okay. But now the next time that you come, you'll have it all down pat, right? Listen, I had trouble logging in myself this morning, so don't feel bad. We're glad you're here. So let's continue to meet for lunch. Now, we're not done yet. Okay, we're going to continue here, but let's continue to meet for lunch. This is every Thursday at noon. This Zoom call is going to feature current information about developments in the law. we're going to have guest experts. And by the way, I just found out about half an hour, maybe 45 minutes ago now, that our special guest next week will be Karen Davis. Karen is an enrolled agent, and Mike will attest to the fact that Karen is an absolute expert on filing issues, credit issues. We both have a lot of respect for her knowledge of the nuts and bolts of tax practice. And so invite all your friends to bring their return preparation questions next week, and we'll see if we can stump Ms. Davis. And like today, by the way, you can mute and unmute as Stephen did and participate. Now, what we have, we monitor questions, and those questions come in either in the chat, they come in SCAPA Connect. I've had a couple that came in early. And so we're going to go now to questions. If you have questions now, please post them in SCAPA Connect, and either Whitney or Catherine will monitor SCAPA Connect for those and then transmit those to us either in writing, or they'll unmute themselves and wave a hand and they'll participate in the program. So we do have some questions. This is the value of this program. The second line on this slide is just from tax notes today, this morning. The question would have been answered differently. Is there any talk about reviving the Build Back Better Act anytime soon? Mike, there wasn't until yesterday.
There is certainly talk about it, perhaps self-generated at times. The talk seems to be that some provisions of the BBB Act are more critical to the Biden administration than others. So, for example, the child tax credit, or the reinvigorated part of the child tax credit, and the fact that people were able to take monthly payments from July through December of 2021. So a lot of talk that they would break up the BBB Act into multiple parts, and maybe they would enact a provision dealing with just the child tax credit, or the child tax credit and the energy credits that the Biden administration is interested in. There may be other provisions that would be less important, maybe changes in 163J, changes in 461L that would be deferred till later in time. The BBB Act had an enormous number of tax changes, and I suspect that if we get them, we're going to get them over months rather than days, and they will be in multiple parts rather than in one single piece of legislation. Yes, there is talk about that, and but I don't think it's anytime soon. I think what we're talking about is maybe toward the latter part of this year.
Good, thanks. All right, now this specific question about the child tax credit, I think you just touched on it. Whether we're going to have it for 2022 or not is a function of a provision in the Build Back Better Act. Is that right?
The reinvigorated child tax credit, including the monthly payments, that is, in the BBB Act and will be enacted or not. Again, as I indicated, the Biden administration is very pro child tax credit. Lots of people depended on that money, and maybe that would receive legislative priority. The child tax credit, as it was originally enacted before the BBB Act and before the coronavirus-related provisions of 2020, that really remains in place, and that's the only thing that remains in place for 2022, unless we get additional legislation.
Speaking of things that remain in place, the employee retention credit was the subject of a lot of upheaval toward the end of 2021, I understood that the employee retention credit for most employers was actually retroactively stopped at the end of September 2021, only available for startup businesses for the fourth quarter and not available at all in 2022. Am I correct here?
Yeah, what we have is, first of all, the employee retention credit costs a lot of money. I mean, if you've done these calculations, you know that clients made a lot of money on the energy retention credit. Top among the people using the employee retention credit, interestingly enough, were law firms and accounting firms. So because of the loss of money, because of political dynamics and whatever, the general employee retention credit stopped as of November 30th, 2021. And so for the last 3 months of 2022, we only had the eligible recovery startup business. The eligible recovery startup business was what was left of the employee retention credit for the last quarter of 2021. You could also use it for the third quarter of 2021. And to be an eligible recovery startup business, you had to have started operations after February the 15th, 2020, and you have had gross receipts of less than $1 million. So you would have had to start a new activity, and there is guidance in the legislation with respect to what a new activity is. But that's all that's there. And now in 2022, there is no employee retention tax credit or employee retention credit of any kind, really.
Okay, Mike, thanks for that. Here's this question about cryptocurrency, virtual currency, I think. And the question is pretty straightforward. If I bought, and you're a lawyer, I'm an accountant, we're trained to read, to be careful readers. If all I did was buy cryptocurrency in 2021, do I have to answer yes to that question on the form about virtual currency?
Yeah, it's a very natural question when you read the front of the form 1040. And the answer to the question officially is no, you do not have to do that. The questions were different in 2020 and 2021, and be sure to read it. Be sure that you have good questions for your client organizer for the 2022 tax season, but merely acquiring cryptocurrency and nothing more, the IRS tells us now, is not an answer or is not a circumstance that would prompt yes to that particular question. I think it's a bit counterintuitive. And, you know, does the IRS really want to know from everyone that owns cryptocurrency? Maybe they do. And maybe that would be not a good idea because it would differentiate or would not differentiate between those that simply own cryptocurrency through purchase from those that use cryptocurrency in other types of transactions. But officially, the answer for our tax season right now, if you go out and buy cryptocurrency for dollars and that's all you've done, the answer to your question is no.
Just bought it, didn't use it. But Mike, as to the IRS's interest, as to what I would call as we all had to be auditors before they would let us be tax people. I learned about scope. If I understand correctly, the scope of the IRS inquiries in their John Doe summons to the virtual currency exchanges has been $20,000. Transactions in $20,000 or more, they want all the information about that currency holder. Less than $20,000, they don't in the John Doe summons. So I think we took care of the employee retention credit, but I want to make sure that we explain letter 6419. Now, Ian and I talked about that last week, but this question came up in the interim. So will you please tell us why, if we got a letter 6419, we need to pay attention?
Sure. People who get letters from the IRS are not really happy, that great things are
You
coming
should be
their
happy
way.
about this one.
And, there's a natural temptation at times to think, if I just throw this thing away, maybe nothing will happen, or nothing will happen for a long time. 6419 is the letter setting forth the payments that the federal government made or the IRS made to recipients of child tax credits. So how much did you get from July through December of 2021? And then the taxpayer says, how much did I actually get, as opposed to letter 6419, which is how much the IRS thinks I got. And if there is a differentiation between the two, then you have to reconcile that differentiation. Maybe you have to give some of it back. Maybe you have to include some in income. But anyway, the letter is an IRS letter, and it basically says, this is how much you got of the child tax credit. And is for us as return preparers to compare the amounts reported in the 6419 with the amounts that the client says he or she got.
And our organizer ought to ask the client to give us the
Good
letter.
point.
Did you get a letter 6419? Include the letter.
Yeah.
Now, don't
Yeah.
go yet, Mike. Looks like we're done, but I caught these. I want to just I don't want to talk too long because I don't want to scoop anything, but here are 4 things I can tell you that we are going to talk about at noon time next Thursday. IRS is explaining the new frequently asked question process. And Mike, we had talked about in this program how the IRS has told us that we can rely on the frequently asked questions. Now they're telling us that there are some we can't. And so they're going to explain the difference, and we'll talk about that next week. The IRS they're leaving all options open to tackle the return backlog, whatever that's going to be. By this time next week, we'll have a much better idea of what they expect, so we can tell our clients what to expect. I have past due returns that were filed before the expiration of the statute on November 15th, 2021 by certified mail. I'm sorry, we filed October 15th by certified mail. We got the little green card back 6 weeks later, the end of November. We still haven't received any of the refunds that are due on the returns that were filed. So I have no idea what's going on. I don't have any information. I got no special information, but I'll bet you that Karen Davis will. Then we got a convicted promoter that failed to shelter his own profits from tax, and it's a valuable lesson for get the paperwork done. My grandpa had a sign in the outhouse that said the job isn't over until the paperwork's done. That's important in taxation as well, right? And then we have updated frequently asked questions. We're going to monitor those for you every week. As the IRS updates frequently asked questions, they are updating what is now official guidance. We want to make sure that we get that in this program. Mike, do you have anything you want to warn us about for next week?
Well, I was kind of interested in the topic here, Lynn, IRS leaving all options open to tackle return backlog. I suppose that's the case, but what can they do that they haven't at least tried to do already? The fact of the matter is that we are seeing, particularly in the employee retention credit, where people would go back and amend the 941 with a 941X to claim additional employee retention credits or claim them to begin with, thinking that because they took a PPP loan, they were not entitled to the employee retention credit. We are actually getting some indications that those payments are forthcoming. Not all of them, not expeditiously, but more so in the last month than we've seen in, since the pandemic started. So I wouldn't say that this is hopeless. I mean, I'm happy to hear about all their new options, but I think they're just winnowing down step by step the enormous pile of work that is left for them because most IRS employees are actually working from home.
Mike, thank you for your important input on privilege and your input on the questions. I'm sorry that you had a little difficulty logging in, but like I said, I had difficulty logging in today myself. So with practice, we'll all get better. Thank all of you for your participation and for sharing this program with us. Again, I encourage questions. I believe there are 2 messages in chat. Let me look at those before we go anywhere. I'd like to read this question. Could any deferment of the advanced child tax credit have taken place that would make the amounts reported on letter 6419 different versus what the client received? And the question really is thinking about perhaps prior year tax balances. I guess the question is, could the advanced child tax credit have been taken or retained to cover a prior year tax liability? And my understanding, Mike, was that it could not. Is that correct?
Yeah, I think that is correct, Lynn. But, the question may very well reflect some difference between the 6419 and the records of the client or what the client recollects. The purpose of this whole process is reconciliation. And, if there's a difference, it's going to have to be reconciled.
Great. Thank you. If there are no other questions, and by the way, you can continue to submit questions, just put them in SCAPA Connect. I monitor that on a regular basis. Be happy to do my best to answer the question. I will, look up the answer, or we can engage the input from other experts that are on the tax team. And it's all part of the member benefit for the South Carolina Association of CPAs. So thanks again. That's it for this edition of Tax to the Max.